Hi everyone, welcome again to my YouTube channel Learn with Debbie, where we make accounting simple. And on today's episode, we'll be talking about ledger accounts. Are you excited like I am excited about this topic? Now let's dive into it. Imagine writing every transaction in a diary. That's exactly what the journal does. The journal is like the diary of your business where you write down every transaction that goes on from day to day. But how do we know the total cash we have? If we'll be writing these things every day, how do we now know the total cash? Because these things happen at different times, in different days, and then how do we compile it together? How do we make a reasonable sense of everything we keep writing? How much do customers owe us? Now that's where the ledger comes in. What is a ledger? A ledger is a book or record where transactions are grouped by account. This is the grouping of transaction by account. That means every single transaction has its own book where everything pertaining to it is recorded. Instead of mixing every transaction together, we organize them into separate accounts such as cash account, sales account, rent expense account, equipment account, account receivable account. So each transaction has its own account where everything pertaining to it will be recorded. The ledger helps us to know the balance of each account at any time. You can just check in the cash account to see how much cash is left with you, how much cash you've spent, how much went into this or that. From journal to ledger, the process is simple. Now the transaction takes place. The first point of call is the journal entry where you just record it in the journal, which account, what happened, which account is debited or credited, and then the ledger account comes next. This is the grouping of the accounts, and then you have the trial balance, and then finally the financial statements, which we'll be looking at in coming lessons. Every journal entry is posted to the ledger. Meet the T account. A ledger account is often shown as a T account with the debit on the left side and credit on the right side. Let's look at our case scenarios. Number one, debit supermarket. So let's say Debbie invests 800,000 naira cash into the business. Now, what is the journal entry? Remember, the debit assets, when they increase, cash is debited, and equity, capital is equity, which is also credited when it increases. Now, this is the simple journal entry. Now, how do we post it to the ledger? This is how you post it. Two accounts are involved in this transaction, the cash account and the capital account. Now, this is how you post it. You debit the cash account with 800,000 naira that is coming in, and you credit the capital account, which is the equity account, with 800,000 naira also coming in, which means both accounts are increasing. One on the debit side as an asset, and the other on the credit side as an equity element. Let's look at another case scenario with the same debit supermarket. Now, if debit supermarket pays 120,000 naira for rent, what is the journal entry? Remember, expenses increase on the debit side, while assets also increase on the debit side. So we debit expense with 120,000 naira. Remember, cash is reducing now because cash is going out. So it will not be on the debit side. Cash is reducing, so it will be on the credit side now. We open accounts for these two entries. Remember, we already have a cash account before now, so we'll just bring it up. The rent expense account, the new one we're opening now, and so cash has already been debited with 800,000 naira. For capital, we will just go ahead and enter the rent expense that has been incurred of 120,000 naira on the credit side because it is reducing the cash we already have. So when you do this, you see if we want to balance this account now, if we want to close this account, we'll just put our balance carry down of 680,000 naira on the credit side, and then we can back balance both accounts to be 800,000 naira. But we're not closing this account yet. We'll look at that. And then the rent express account that we just opened will be debited with the cash of 120,000 naira. This is how you post from your journal entry to the individual ledger account. Why are ledgers important? They are important because without ledgers, you won't know your cash balance. You will know how much your customers owe you, or preparing financial statements becomes difficult. Now, ledgers keep every account organized. A common mistake beginners make is to think that journal and ledgers are the same. No, they are not the same, they are different. The journal record transactions in the order that they happen, while the ledger groups transactions by account. Let's have a quick practice. A business buys equipment worth 200,000 naira in cash. Now, the question is, which two ledger accounts will be updated? Our answer is the equipment account and the cash account. The journal entry is simple. You debit the equipment account with 200,000 naira and you credit cash account with 200,000. Why? Equipment is an asset that increases on the debit side. The cash is also an asset, but this time it is decreasing to be recorded on the credit side. Now, today you learned what a ledger is, the difference between a journal and a ledger, how journal entries are posted to ledger accounts, and why businesses need ledgers. Think of the journal as your diary and the ledger as your cabinet. So the journal records every event in order, while the ledger organizes those events into separate accounts. Once you understand this flow, you're one step closer to preparing financial statements. Remember, accounting is easier than you think. I'll see you in the next lesson and learn with Debbie.